Welcome back, traders. Got another ICT lecture today, how to disqualify first presented fair value gaps. The first presented fair value gap, which I'll just call the first fair value gap, is something I've incorporated into my trading since he taught it in 2024. This year, he had said sometimes he would ignore the first fair value gap in favor of another nearby fair value gap. So sometimes you should disqualify this PT array just like sometimes we would disqualify his other PT arrays. We don't use every single fair value gaps or order blocks or changing the state of delivery, right? So let's hear from the horse's mouth on how he would disqualify the first presented fair value gap. Please give this video a like and subscribe. The original video is linked in the description.
Folks, welcome back. All right, so we're looking at the review from Monday's trading. All right, so let's take a quick look at the daily chart. This is what we were looking for on Saturday or Sunday, I think it was. Before the market opened up, I shared my analysis and I said that we would likely open below this low, gapping down and trading down into this inefficiency here. That's a real liquidity void. And that low here had sell side, and we're going to see how we opened on Monday. We opened below that low at 17,113.25. Traded lower, made a lower low going into the 7 o'clock hour Eastern time in Asia. Sunday night going into Monday. Here is S&P, same thing, lower gap opening. And again, we're going to look at these two lows here. But first, we're going to grade the opening range of this gap here. So this is new week opening gap, where we opened that range we created. Half of its consequent encroachment. So new week opening gap high, new week opening gap low. This is for Monday's trading. Look at the lows here on NASDAQ on the left-hand side. We have this low and a lower low. While on the S&P, ES made a higher low. So that kind of told me that we probably did enough for at least the beginning of the week, gapping down like this. I'm not going to go so far as to say that's the capitulation that I think is needed for the low to be in. It's just too many things going on. Tariffs are being pulled back. Higher tariffs are being threatened. It's just it's a mess. So it's going to cause a very erratic price action. So your leverage needs to be dialed way back, or basically you're going to get your clock cleaned, meaning smashed. All right, and here is that liquidity void I mentioned on the daily chart for NQ, and look how close it got to it, just above it. That's good enough for government work, right? Again, divergence between the lows.
Pausing real quick, I want you to note the time for this SMT divergence. It's from 6 o'clock p.m. to 7:15 p.m., the first hour or so of the Asia session. Now, I'm not very booked up on SMTs, but to me, it seems like the beginning of sessions, Asia, London, New York, AM and PM are the times that are important to know SMTs. So if you do trade SMTs in your trading, make sure you pay attention to the time.
All right, and then here is NASDAQ over here, and this low in the London session, right below that low here is sell side, and same low respectively to that of the ES, and the market traded down. And we're going to look at this little area in here. But for now, just note that I did not get this entire run up. I didn't want to hold on. I wanted something very easy, low hanging for a target, relative equal highs, and relative equal highs here. And this high here would have been just as good as an upside target, not getting any of this. We're going to zoom in on ES first, and I'll cover this. So here's the London session lows that had sell side below it. And here's the buy side liquidity and another form of buy side liquidity right there. Okay, so 8:30 time. That's when the algo will start spooling, even when there is no news. And we have that here. Trades to get the sell side down here. Now, I want you to take a look at this, and I highlight the exit. Okay, so that's why you see it highlighted down here. I'm hovering over top of this arrow, so that way the little exit arrow appears on the chart. So I got out at that buy side here, and I did not get any of the extra run, and it's okay. So you can see this candlestick here, the down candle, and then the next candle here. That is the very first presented fair value gap of 9:30 to 10 opening range on Monday. So this, and we took out the sell side at the London lows. When price was in this area here, I felt that it was warranted to make a run for the buy side here. We're going to zoom in on the NASDAQ now, the sell side, taken here, the buy side liquidity. But let's zoom in here because I want to teach you something in regards to the first presence of everybody got. So this is the structure here. We have original consolidation, buy side, the market's tanking, it went lower. Early on in the session on Sunday, we had SMT divergence that never got canceled out. So it set the stage for the lows that were formed in Asia on Sunday night. Those are the weekly lows, and we can start looking for sell side to be taken and then reject that and start to look for buy side. Not because we're trying to pick a low, not because I think a low is in. It's just they put an extreme gap, which is what I outlined on Sunday before the market even opened up. The market tanked. It took out the London lows during the opening range. So here's opening range 930, and then trades down into 945, 946, 947, and then this was the first presence of everybody got. Now I know some of you think that it's this one. Now, why is this not a valid first presence of everybody got? You ready? This is your opportunity to pause the video and think about the differences between what I just showed as mine and that one.
So I paused the video for like 3 minutes and I didn't really come up with anything that made sense to me or follow any of the rules that he's given before. So this has got to be a new rule. The best thing I could think of was that this lower fair value gap was when we had a stop hunt on the sell side liquidity. So that makes it more important, but I don't think that's correct. It doesn't really make sense to me. So I give up. Tell me why.
All right, so here's what some of you think was the very first presence of everybody got. But why is it not a valid first presence of everybody got? Because you need to look at where it is in proximity to the candles that formed just before it. Watch. See the body on this one? And the body here. And then this one, the only thing it did was trade down and wick through the discount wick of this candlestick, the consequent encouragement. This whole area here is a balanced price range. So if there's a gap that would be formed inside here, that's not essentially breaking away from anything, is it? Because it's still inside of this balanced price range. So the only portion that would be considered a gap would be what? The bodies, or this body to this candlestick. There's no gap there. There's no imbalance here. All this is reflecting is it's leaving this balanced price range with all of this back and forth. And think about it this way. This candle opened up here, traded all the way down to that low and closed there. The next candle opens exactly where the previous candle closed. Then it trades up. And then the next candle, we open here, do a little bit of movement up, and then trade down to that low, and we stop here. We've had range delivered here in the majority of what this would be viewed as a fair value gap with these candlesticks. And this one went lower. So it's not accurate to call this an inefficiency. It's not. It's part of this larger range that's been traded back and forth. And then when we get this candlestick here, this is actually a gap from this low to that low. So look at the real inefficiency here. And there it is there. Now I'm entering right at the consequent encroachment of that there. So there's the difference. Hope you found insightful. Until I talk to you next time. Be safe.
Ah, I see now. So the reason is because of the balanced price range and where the actual inefficiencies are. Now, sometimes we would look at fair value gaps within old balanced price ranges, but this fair value gap happened as we are creating the balanced price range. So basically, the balanced price range out-trumps this gap. So we use the first inefficiency outside the balanced price range. Now, one last thing, this entire up and down movement is the balanced price range. So on the upside, if you were looking for this fair value gap to take a long in, don't expect it. Why? Because like this fair value gap, this BISI is entirely within the balanced price range that just happened. So at this moment, this is not actually an inefficient level of price. Remember what he taught about breakaway gaps. So you can use this by putting your stop loss at the low of this fair value gap, thinking that it will not get closed in all the way. So you can reduce your risk. This is a great lecture, short and sweet. After this, I really want to change how to look at the market and really pay attention to balanced price delivery and price imbalances. This is something that can help you filter out all the other fair value gaps and only pay attention to the ones that matter, if that's something you're struggling with. So anyways, please like and subscribe. And if you had any key takeaways, leave a comment saying only fair value gaps outside balanced price range. only fair value gaps outside balanced price range. And until I see you next time, safe trading.